I dare say I've been stupid, but every day I realize the things that she had and that I lack. Beauty and wit and intelligence and all the things that are so important in a woman.
You have qualities that are just as important. More important, if I may say so. Kindness and sincerity and, if you'll forgive me, modesty mean more to a husband than all the wit and beauty in the world.
If you love listening to this show, please consider giving a rating and a review on Amazon Alexa or wherever you listen. We want to continue bringing you this amazing content, and part of our ability to do that means that we need a big audience. Now, it may not seem like much, but rating and reviewing the show will help more people find us, just like how you found this show. Simply on any podcast platform, search for a show, scroll down to the bottom, and push 5 stars. It's that easy. Thanks for supporting the show. Today, I'm joined by Sir Ronald Cohen, who is the chairman of the Global Steering Group for Impact Investment and the Portland Trust. Welcome to the show today.
Pleasure to be here with you, John.
So, Ronnie, you have been a pioneer all your life, and you founded the British Venture Capital Association as well as the European Venture Capital Association. And I wonder, before you founded these associations, what was the VC landscape in the UK and EU back then?
You know, at the time when I kicked off, Scott, people didn't know what a venture capitalist was and had trouble spelling the word entrepreneur. Fear of failure was the prevalent cultural value, and a lot of people thought that entrepreneurship would be a US phenomenon. Of course, what we've seen is that an entrepreneur is an entrepreneur wherever he or she is located in the world. So Europe, Britain have come a very long way since then.
Well, it's interesting because, I think when people think that innovation is somehow specific to a region, whether it's Silicon Valley or New York City, how I think myopic that perspective is. And you help to institutionalize the fact that there is incredible gems, talent pool, and academic research that was coming out of both the UK, but also the EU side as well. So thank you so much for sharing that. But there's another area that you've also been a pioneer, which is on the area of social finance, long before it became a popular vernacular. And I want to maybe ask you a little bit. Again, I wasn't sure if it was during your Apex Partners days, but when you started to identify this social impact portion of investments that maybe others were kind of overlooking. And at what point did you figure out that there was this both a need as well as an opportunity?
So at the end of the 90s, when I was leading Apex, it became obvious to me that our system was creating huge imbalances in terms of wealth. And of course, we also had mounting climate challenges, which have continued to mount since then. And in 2002, at the 30th anniversary of Apex Partners, Scott, I actually made a speech where I said, if we don't deal with poverty and the gap between rich and poor in a different way, then a curtain of fire would arise to separate rich from poor. So the idea was in my mind, and when I left Apex in 2005 at the age of 60, I did so to focus on social issues on the one hand and the Israeli-Palestinian conflict on the other. While I was at Apex, therefore, I started to walk the path of impact in investment, and in 2002 created Bridges Ventures, which is one of the very first impact venture and private equity firms.
So as I'm listening, what's fascinating is that my background, my training is in neoclassical microeconomics, and I've been kind of taught to think a certain way, but I think experience has taught me, I think, even more. And what's interesting from your perspective as a capitalist, as an investor, seeing that the classical model, neoclassical model of what we define as economy and the economic systems, yet it doesn't quite work perfectly, and there's still these market inefficiencies and gaps that are not quite addressed if you were to leave it to its own set of system and processes. So back then, I'm curious, what was your thinking around how do you start to inject? Because again, you're going to get up against hardened, institutionalized pillars that are hard to move around. And of course, you have special interest groups and so forth. But again, they're not taking into consideration the negative externalities that they're causing.
So, I mean, broadly speaking, what's happening in the world today is that our economies have already started to shift, Scott, from making business and investment decisions on the basis of risk and return to making decisions on the basis of risk, return, and impact. You look at $40 trillion worth of ESG investing now, which is changing the valuations of companies on the stock market because they pollute or they engage in unsavory labor practices. You look at a generation of young people who don't want to buy the products of companies that are creating harm and don't want to work for these companies. You see technology taking huge leaps. You're a tech investor yourself. Artificial intelligence, machine learning, augmented reality, the genome and computing coming together enable us to deliver impact in ways we could never have contemplated before. And unseen to the naked eye is the fact that this technology and big data enable us today to measure the impacts of companies in a granular way. If you look at the Harvard Business School effort I'm involved with, the IWA, Impact Weighted Accounts Initiative, you'll see the figures for 3,000 companies' environmental impact. If I say to you, Scott, that 450 of these 3,000 companies create more damage in a year than they make in profit, that begins to tell you the sort of insights that emerge when you measure companies' impact. I could go on, but most importantly, for us who have been involved in the investment world, you can already see a correlation in the Harvard data between companies that pollute more and lower stock market valuations. So impact data has become valuation sensitive. And that's why you're seeing regulators like the SEC and the EU and accounting bodies like IFRS, which sets accounting across the whole world, besides the United States, pouring on this question of transparency. So this shift to risk, return, and impact is supported by increasing transparency on the impacts of companies. And the goalposts have moved now. If you want to raise money, whether you're a company or whether you're a venture capital fund manager or a private equity fund manager, investors are going to ask you about your impact. And that's the reality. And so we're living in a transition period now, leading up to the mandatory publication of impact accounts of what we've been preparing at Harvard Business School.
Yeah, so I think in many ways you've actually started to answer some of the questions that I had for you, but I want to see if I can actually go back a little bit. And by the way, great point about rethinking the CAPM and the way we think about modern portfolio theory and what it constitutes from a full equation and that missing component that's always been there from impact accounting. So it's great to see that. Going back to your days at the UK Social Investment Taskforce, again, the reason I'm kind of trying to provide a before and after perspective is back then, the challenges around impact investing was very different, right? So if you could give us a little bit more context and color around the perception of, impact means maybe lower returns and so forth.
You may also like our quarterly Ask Your Perkins event that brings some of the most notable experts and category leading startups in their area of sustainability and human survival on Earth and in space. To register, visit astroperkins.com/events.
Yeah, I mean, the Social Investment Taskforce focused with a more entrepreneurial eye, as the British government asked me to do, on how we can better tackle social issues. And the bottom line was by bringing investment to those who want to improve lives and the planet. Now, it took us 10 years to develop the Social Impact Bond, which was the first security ever where the financial return depended on a social improvement. In this particular case, a reduction in the number of young people returning to jail. At that time, we thought, okay, we've solved the issue of bringing capital to leaders of non-profits or profit-for-purpose businesses that are going to be providing lower returns than market, although there may be very attractive risk-adjusted returns in the case of social impact bonds. But as the years went by, and I chaired the G8 task force in 2013, I realized that what the social impact bond did was to optimize risk, return, and impact, which is where the whole world was going, where ESG investing, which was then 10 trillion, was leading us. Today, it's over 40 trillion. Impact investing, where you measure the impact created, was non-existent. Today, it's more than 1 trillion. And then we began to realize that because of these changing values, this new normal was actually a better way of delivering returns, whether you're a business or whether you're an investor. Because of these changing values, if you wanted to hold on to your talent, to your customers, if you wanted to attract investors, then you had to deliver impact as well as profit. And we began to realize as we invested, and I invest in early stage tech impact ventures, began to realize that it's actually a way to deliver higher returns than just optimizing risk return. Because when you invest according to risk return impact, you become aware of risks that you would otherwise ignore. A coal mine, what was the risk of its asset values falling because of pressures from people who are concerned about climate change and practices that involved using child labor that could hurt your sales and so on. And so, as I say in my book, Impact, Reshaping Capitalism to Drive Real Change, the new paradigm of risk-return impact is going to be as disruptive as tech was. The impact revolution is going to change business models using tech and bringing impact in the way that Tesla has done to the automobile industry. That's just a precursor of what we're going to see in every industry where impacts today aren't what they should be.
So I want to kind of hit on your some of your points, and maybe you could also drill down a little bit into your book as well. That's come out last year, but now it's being translated and coming into, I guess, the U.S. market. So what's interesting is this: now we have a yardstick, a way to measure, right? So I think there's a lot of nuances in terms of, again, you mentioned some of the frameworks and some of the working groups and the organizations that's trying to standardize things. So there's things around how to measure, what to measure, and how to report it, right? And then the accountability and the enforcement aspects. Can you talk about how those different mechanisms are changing, and what are the gaps today versus where do you think things are going to be heading in a few years?
So you can see an indication of where we're heading with what happened at the shareholders meeting of ExxonMobil, where shareholders forced 3 directors off the board and imposed 3 directors that management didn't want, or the censure by 2/3 of shareholders of the Procter & Gamble shareholder meeting a couple of months earlier because of the deforestation that P&G is creating through its use of palm oil, right? So we can see investor pressures and the pressures of consumers and of talent forcing companies now to take this issue of impact seriously. But without measurement, we have greenwashing. We have companies making misleading statements in an effort to improve their image with consumers or talent or government, everyone. And this has to stop. You can't have people pretending that they're delivering positive impacts because that's what matters to all these different stakeholders when they're not. So we need transparency. And the situation, Scott, isn't that different from the situation after the crash of 29, when investors realized they didn't have transparency on profit. And 4 years later, the Roosevelt administration famously introduced GAAP accounting and auditors. And we need now transparency on the impacts of companies. There's $40 trillion of investment seeking impact as well as profit without being able to measure anything, relying on qualitative mentions in reports and disparate metrics that are incomparable. So the big challenge for our society, the big challenge for us in coping with climate, and the big challenge for government coming out of COVID in bringing business and investors to its side in trying to cope with the economic consequences of COVID, all lead us in the direction of mandatory publication of impact accounts. And the Harvard effort, everyone can go to it, it's open source, you just look for HBS IWA. The Harvard effort shows that it is both feasible and valuable. And so impact accounting is going to become the norm, Scott, within 3 to 5 years. Because if it's price sensitive information in terms of stock prices, regulators are going to have to maintain an orderly market by making sure that the information is reliable, comparable, comprehensive, and that every investor gets it at the same time, right?
So it's interesting because in the context of stocks, for example, or publicly traded exchanges, there are mechanisms for analyst consensus. So essentially data that everybody believes is a truth that they can rely on for decision making. I wonder how we can start to see some of these, not just reports published by the companies, but a third party, again, let's say Bloomberg or others, S&P 500, that can start to really track it and have scorecards that becomes publicly available for the likes of analysts, shareholders, and as well as even retail investors to be able to ascertain what the truth is. So that's one question. The second question really is, in order to get to that point of that level of, let's call it less ambiguous, more quantitative, what are the sources of data that we need to measure impact, given the fact that when we say impact, that could range everything from agriculture to even just enterprises that are in, let's say, cloud. So it's very different sets of yardstick measurements. So how do we get the data, and how do we know that it's something we can rely on?
Don't forget to visit astroperkins.com to register for our next quarterly events. Past and current speakers include Damian Vaughn, former NFL player, Neil Gregory, Chief Thought Leadership Officer at the IFC World Bank, and many more. To register, visit astroperkins.com and click on Events.
So at the moment, the rating agencies and Bloomberg and others are measuring companies according to their governance. Do they have somebody on the board who knows anything about impact, etc. That has no correlation with the impacts of companies as they appear in the Harvard data, right? There's very low correlation between the ratings, the impact ratings that the rating agencies are giving, and the actual impact on the environment of these companies. So we have to shift to data which is produced by the companies in the same way that they produce financial information, according to a set of accepted principles, and this data has to be audited. And when you get that, the Bloombergs and the others will add it to their screens, and you and I and other investors will be looking at PE ratios on impact-weighted earnings per share, looking at correlations between growth of impact and future growth and profitability, and so on. So we need now to avoid the confusion that is being created by analyzing disparate, unreliable information.
I love this. Can you talk a little bit about sources of data? So aside from data that's generated internally by the organization, what are some other sources of data that companies can use to start to assemble that analysis?
So there's a lot of data around about climate now. We at Harvard prepared the monetary value of the environmental impacts of 3,000 companies on the basis of information that they had made available, the companies had made available about their CO2 emissions, their water usage, and so on. But we had to build a pathway to monetization. We had to say, okay, you got so many tons of carbon. We've looked at all the figures and we think $300 a ton is the real cost to the environment. There then can be a debate of whether it should be 300 or whether it should be 100, whether you should discount these future numbers, because of course the environmental damage lasts over time in the way that we discount the financial cash flow. Reasonable people can debate what the right accounting rule should be, just as we do with financial accounting. And we have to get there, Scott. We have to set these rules now. Once you've set them in place, then the objective analysis of these metrics, the comparisons across the world, will be like the analysis and the metrics that we do today on the financial accounts of companies. Like we analyze a company's accounts and we make accounting adjustments, we compare with different companies, we look at different ratios of efficiency, and we'll be doing exactly the same thing for both impact and profit. And so all of your data providers, if they have reliable data, will develop sets of tools using some of those that we use already in, in financial analysis and in valuation and so on and so forth, but no doubt developing also a new set of tools to analyze the impact performance of companies and put them in proper context.
Now let's talk about something kind of practical. When we spoke with the IFC, the World Bank that is rolling out the operating principles for impact management, and of course, lots of pensions institutionals are adopting. But one of the challenges I think that they've kind of observed is there's on one side there's this urgency, and all of us know the IPCC and other reports that have come out, and the time urgency to really change things around to get to a point of carbon neutral, let's say, for example, in the next 10 years. But yet, a lot of the things that you're talking about, tools, measurements, methodologies, audits, and so forth, takes time. And IFC's approach, at least when we last spoke with them a few months ago, was rather than being very prescriptive and trying to dictate what that looks like, giving them opportunities to be versatile and create their own methods, but also providing the set of best practices and frameworks so they can leverage it. And the reason for that thought process is prescriptive forcing everyone to follow a certain method, something that's equivalent to a gap analysis, for example, for accounting, could take years, if not decades, to adopt, and we don't see the necessary net results that we need from a change as it pertains to climate change. So how do we balance that out in terms of the need for urgent changes and the need for rigor?
What reconciles them is an announcement by government that 3 years from now, companies must publish impact-weighted financial accounts. When that announcement breaks, companies begin to measure their impacts already. They begin to try to get their impact house in order, right? They don't want to look bad when these figures emerge. And just as we did with financial accounting, the initial years of gap accounting were much less precise than gap accounting has become 9 decades later. So we will keep improving the system. But we have to head to the right destination. And the IFC agrees with this. I've participated in some of their meetings in Washington. We want everyone now to shift from just awareness of impact to understanding of it and measurement of it. But to get them to focus on the right sort of measurement, they've got to know that reliable audited figures are going to be required 3 years from now or 5 years from now, or whatever it ends up being. It took 4 years after the Great Gap crash to have the first piece of legislation on gap accounting. I don't know why it should take longer this time to do the same thing for impact accounting.
Now, on the topic of legislation and really government's role in policymaking, we've seen within EU, and this is a transition to talk about actual, new investments versus reshuffling or reallocating within a portfolio, is when it comes to green projects, and EU has been very mindful, very thoughtful about, how do they set the policies, how do they avail the capital and guarantee those capital, and to make sure that it's really taking effect. So, and we start to see some real tangible evidence of this around hydrogen, for example, in EU, other clean forms of energy, electric vehicle, and really, unlike some of the other regions throughout the world, we're seeing the capital cascade down to the PEs, the VCs, and others that's actually tangibly backing the startups that is supporting climate change mitigation and adaptation.
Yeah.
It's working. But I wonder, are other parts of the world, and again, I've heard from many different sources that other parts of the world, it's a very different story, and everybody's on different levels of readiness, maturity, and action and enforcement. How do we get everybody in lockstep to solve a world crisis, really?
Well, when tech investing came, a lot of people thought this is just going to change the computer industry. I was there, I was in my mid-20s. This isn't going to go very far. And of course, we know what happened, all right? It didn't stop with the PC, it went to the cellular phone, to the internet, and on and on. Changed all our lives. The same thing is happening with impact now. People are saying, this impact business, it's going to affect the fossil fuel companies, but it's not going to come to affect us in our particular niche of manufacturing. And the answer is those who don't embrace it are going to find themselves left behind. Look at what Tesla did to the automobile industry, right? It established itself as a major competitor in it and shifted the whole of the industry to electric vehicles. The entrepreneurial activity around tech and impact is huge. I see it coming from all over the world. I see new education models where you can get a university education digitally and pay for it after you've got into a job. We were never able to do that with brick and mortar education, right? You're talking about energy storage. I see entrepreneurs saying the solution is going to be to store energy in water, and it's possible to do that, right? So you're finding the technology and the impact thinking converging now to disrupt almost every business segment. It's happening in health with remote health. I've mentioned education, but let me give you an example of just how disruptive it can be and how it can lead to growth and profitability. There's a company here in Israel from where I speak today, from Tel Aviv, called Orcam, which I mentioned in the book. Great entrepreneurs, they sold Mobileye out for $15 billion to Intel from a greenfield startup. They created an impact venture called Orcam to provide spectacles to help the blind and the visually impaired. Now, you'd say, wow, that's unbelievable. A device that enables a blind person to have whispered into their ear the page of the book they're reading, 300 faces of people who have been inputted, that just transforms the lives of potentially 35 million blind people and 250 million visually impaired people. But if you think as an impact entrepreneur, and you ask yourself the question, how can this technology help the greatest number of people in the world? You get a surprising answer, Scott, which is, what if you provided these spectacles to the 800 million illiterate adults in the world? What does that do for their lives and livelihood? And what does it do for your business model to shift from 300 million people market to an addressable market of 1.1 billion, right? So you reveal opportunities that you otherwise would never have thought about.
Yeah, I think you bring up an interesting point. One point is this notion that when we think about impact, and certainly impact investing, and again, when I want to qualify that it's not reallocation, but new money going to new projects, which is really critical, is that it's not something that's obvious. Certainly the EVs, the storage, the solar PVs, those are very obvious from upstream. But there are other things that are tangential or different sectors that still has a huge impact, right? Stem cell research, CRISPR gene editing, cell reprogramming, and the list just goes on. So this notion that exponential technologies has a critical role in the revolution and the transformation to this rigorous, measurable, reportable new world of impact accounting becomes almost necessary. I want to ask you a question, which is, for those institutional investors, as well as those that are investing for themselves, and they're looking for new opportunities to invest into green companies. Again, I'm not talking about pre-existing companies in the sense of publicly traded, but let's say even private companies. How do they know, one, that, because of the oftentimes very technical, scientific, and difficult type of subjects that the startups are working on, how do they overcome that, let alone being able to actually really ascertain is, in fact, this startup is truly a global and a green impact company?
So, I mean, it's no different than the early days of VC, right? When nobody understood technology and we were all trying to work out which companies are going to be successful. You take those that are driven, first of all, by real passion to achieve impact as well as profit. They're people who typically want to measure their impact as well as their profit. And then you have to work out, are they capable of delivering on this vision they have? Can they deliver these new technologies? And if you have a diversified portfolio with great people, some of them will be very successful and some of them will fail and pick themselves up and try again. So you need to have a diversified portfolio. But what we're beginning to see now, Scott, is new investment firms arising, or within big firms, new funds being launched, which are impact funds. And these are sort of creating the path for these firms to migrate wholly, which is what's going to happen to them. A decade down the line, they will all have migrated to measuring their impacts as well as their profits, because that's what the investors want, and that's what the talent want, and increasingly, that's what the entrepreneurs are going to be doing.
Let me ask you a final question, and we're going to wrap up here for today, is at a later point in your life, when you look back at the entirety of your life, how would you go about measuring and grading your personal impact?
Well, I think contributing to the growth of the venture capital industry in Europe and across the world, in places like Israel and India and elsewhere, it's not very easy to measure the specific impact, but you can see that it wasn't there when I started, and I played whatever role I played in making it happen. Today, I would say that my personal impact will be measured in the number of ventures that touch billions of people's lives and improve them, and that improve the planet. If the vision in my book is right, we are at the beginning of an impact revolution like the tech revolution, which is going to improve the world hugely because of the change in values, because of technologies that enable us to deliver impact in ways humanity could never contemplate, because of technologies that enable us to measure the impacts of companies. And if that comes to happen, then I'll feel my life was worth living.
Amazing, amazing response. And with that, I have been joined by Sir Ronald Cohen, who is the chairman of the Global Steering Group for Impact Investment and the Portland Trust. Thank you for joining today.
Pleasure to be with you. Goodbye.
If you've enjoyed this episode, take a moment to rate our show on any podcast platform that you listen to. Scroll down to the bottom and push 5 stars. It's that easy. And as always, thanks for listening.